If you're wondering what your favorite tech stocks are likely to do this Monday, then this is the video for you. Stick around, don't skip any part of this video, because I'm going to show you one of my very powerful and easy strategies on how to gauge the market for Monday early in the evening on Sunday, the night before I am able to gauge the likelihood of where the market's bias is going to be, neutral, bearish, bullish, in the direction it's likely to go in the early evening, late evening, and overnight hours, Sunday into Monday. So don't skip any part of this video. And I'm also going to be showing you inside the candlesticks and an inside look at what hedge funds use to gauge data on the charting daily so you can gain an edge. And it's what I teach my students in the Discord consistently, is how to gauge the market over the weekend to know where the following week is likely to go. If you're looking to get better in the stock market, grow your portfolio, and just overall improve your performance, let me show you how to turn losses into wins consistently, and you'll make profits just like you see on the screen. The link to join the Discord is in the information box below. Look forward to seeing you real soon. Today, we're going to be talking about the VIX, Meta, Google, Microsoft, AMD, NVIDIA, Palantir, and SOFI, and we're going to be going over these stocks. I'm going to show you guys a very specific ticker in addition to the VIX and how to gauge the strength of the U.S. economy. So you don't want to skip any part of this video, because I'm going to show you how to gauge the economy, and I'm going to show you how to gauge the market's movement in the week on Sunday. Let's dive right in. So first, we are looking at the VIX. When the VIX goes up, the market's going down. When the VIX goes down, the market's going up. And you can see that over time, the volatility has decreased. It jumped up on tariffs, spent a lot of time up here until they paused tariffs, came down, and then when the deals started getting worked out, it made its way down in between the orange and the red, then the yellow and the orange. Then it consolidated between the green and yellow, jumped above yellow, touched orange, came back down in between green and yellow again, and then worked its way all the way down to $16.28, which is really, really low, which is good. And then it's worked its way back up into the yellow range because fear is heightened due to Iran and Israel. And not only that, also the tariffs and how they're in place now. And there's a deal with China, but there's still tariffs that are going to be implemented as part of this deal. So people are worried about the percentages and how that will affect trade. And not only that, we're also concerned with tariff deals with other countries. Also, data that was a little bit soft that we expected to be slightly better on inflation. Although we beat expectations, there were quite a few investors that were hoping for even better and expecting better numbers than what we even got. Rate cuts are looming, and we are also waiting to see what happens with that data in this week coming up. So when the volatility index is in between my orange and red, which are my custom areas, and I've created this over the years that I've been trading with my experience on where I would likely trade and not likely trade. Anything above red is highly volatile. Between orange and red is heavily volatile, not quite as bad, but still heavily volatile. Between yellow and orange is moderately volatile and is a decent opportunity for making money as long as you're getting into the right stocks and taking advantage of IV crush on earnings, or you are playing your options correctly. Between green and yellow is heightened volatility, but it's generally much better. And so it's not as bad. And this is usually a good area for making pretty decent premiums, but overall below green is best. It's the most stable and the most consistent. And as an option seller, you want the VIX to be below the green, because selling put options is not really a bullish strategy. Selling put options is neutral. If you're bullish on a stock, you'd be buying call options or buying shares. When you sell put options, it's not because the stock is necessarily bullish, it's because it's reached a bottom and you want to get in. So if the stock drops just a little bit more, you get assigned, but it won't drop much more because you're trying to get in at the bottom or near the bottom, or the stock is consolidating, so you're using the put options to make money, but don't care if you're assigned, and a dollar cost average the shares you already have. However, straight selling put options is not a 100% bullish strategy. It's more of a neutral, and sometimes could bias towards bullish or bearish, but it's fairly neutral, and you're using it to hedge, add to your position, dollar cost average, and make premiums. But you'll make more money buying call options, although more risky, if you're extremely bullish, and you'll make more money for sure by buying shares. So typically, when the stock market is below green, below $18, and it gets down into 16, 17, or even lower, then the market is pretty stable. The volatility is low, so you make money off of consolidation and safety, and it gives you more room for error. And we can see that the VIX is definitely winded down. But we've got a lot of data coming out this week, and I want to dive into exactly what's going on with this data and explain to you guys why it's critical to understand what's happening. Inflation data was supposed to be 2.5 expectation. We had 2.4. That's good, but we had 2.3 previously, which means inflation went up a tick, which is not good, which is 0.1%. And if it had went down to 2.1 or 2.2, rate cuts would almost be guaranteed. We still have a decent shot at getting them this week, but I think we're going to have another delay, and they're going to postpone the July cuts to August or September because inflation went up slightly. It still beat expectations, but it went up. Keep in mind, in 2024, inflation was hovering around 3 or 3.1 or higher, and in 2023, it was even higher than that. So 2.4 is pretty darn good. And remember, something else that maybe you've heard of, don't understand, or maybe you've never heard of it. Housing starts, building permits, overall, the real estate market and auto insurance is a lagging indicator. And these indicators are what can really hold inflation up even after it's recovered, and they're starting to recover month over month. So with those numbers improving drastically month over month, that's why inflation's starting to drop, like Tom Lee said many times over the past 8 months, dropping like a rock. That's what he had said back in November and December, and it looks like that's happening. But there are now some heightened worry and heightened fear with the geopolitical tensions and tariffs, of course. And we have retail sales month over month on Tuesday. We also have building permits and housing starts on Wednesday, and we have the FOMC meeting, and we have the rate decision on interest rates coming out on Thursday. And then on top of that, we have the Fed press conference on Thursday as well. So there's a lot going on this week, and it's looking like it's going to be choppy, but I'm going to show you guys in a few minutes after we look at some stocks how to gauge what is likely to happen in the market Monday morning. And you're going to be able to do this very, very early and late in Sunday night and evening into the overnight hours into Monday. I'm going to show you exactly how to do that, so stick around. I'm now going to show you how to gauge the strength of the US dollar against the Japanese yen, as well as the British pound, and of course, other currencies around the world. I promised you I would show you that, and it is with the DXY. The DXY below $1 or $100 is not good. It shows weakness. It really needs to be somewhere up in this range, and it's very weak. It's actually at a very all-time low. The tensions in the Middle East are not helping it, and definitely not being helped by uncertainty on the tariffs. These aren't helping it. Crude oil is up. There's a lot of things going on, and we're waiting for some strength and some turnaround on the US dollar, because this ultimately is showing the strength of the economy in comparison to other currencies around the world. And I've explained this before. If you want to hedge your portfolio, this is for another video. If you want to see more detailed information on how to hedge your portfolio in a downward market, comment below and I'll make that video for you. It's on the DXJ Wisdom Tree, FXE, FXI, and SPHD and VYM. This is going to get you exposure to Japanese ETF, the Euro dollar, Euro ETFs, the China stock market, and some high dividend yields and Vanguard yields, showing you how to balance your portfolio long-term for safety. One thing you really have to understand, there's also, in addition to all of this data we're about to talk about, you have to understand the geopolitical tensions. All of this data can be good, but if Iran and Israel keep going to war like this and it gets any worse, well, then the market is going to suffer due to crude oil, gold, silver, the way people would sell Bitcoin, commodities would change, futures, the bonds, and of course the stock market, the fear and greed would change. Everything could change. Data is good, that's awesome, but if geopolitical tensions get worse, that is going to mitigate this. Even with rate cuts happening and good data, if geopolitical gets worse, it's going to be a rocky week. If geopolitical eases up and data is good, we will be okay. But data directly affects the market, so you have to be aware of that. That panic selling could happen at any time if things get drastically worse. It could happen, I don't know, but it's definitely a risk. So be very safe in the market, watch the news, and stay on top of everything. Starting off with AMD, we can see they've made a pretty significant run up from $84 back in April all the way back to $116. So if you had invested then, you'd have almost a 20% return. I said AMD was a good buy back here when it was $114, and then at 96, I said the dollar cost average, and again at 76 and 84. If you'd done that, your average cost would likely be under 100 and you would have some very significant profits. AMD is doing well. They have a lot going on right now. They're unveiling new technology. They're taking on NVIDIA with more efficient processors and servers. And without making this into an AMD video, if you want to see more on AMD, that video is right there. I posted it yesterday. But AMD is poised to run with good data. I totally anticipate AMD in the coming few months working their way up with good news as long as data and tariffs are good. This stock is beat up and it's at an all-time low, or just about. All-time lows are really between 75 and 85. When I look at my AVP, average weighted price, which is a custom strategy I created off hedge funds, it is something that I developed over the years with my experience, and it's very accurate. And AMD is sitting in my AVP, or at the top of it, because the AVP on AMD is actually between $100 and $125. So 100 to 125 is the AVP. If you want to play it safer, 1 to 120. So we're right in the mid to upper part of AVP. You should be looking at AMD because all stocks eventually, especially good companies, return to where they were before. So if AMD gets anywhere near 200 again, you'd be looking at a double return in the next 6 months to a year, or even in 2 years, that's still 50% per year. Heck, even 3 years is 30% per year. So it's a very good opportunity because the stock is all the way down here. And you can always sell put options down at 105 to 110 going a month out. And then you're getting in right across the average with lots of upside potential. Stock market moves like a magnet. It moves towards big orders, and there's a lot of sell orders up here, and the market is going to move up. People are going to buy it. The stock's going to improve it. It's going to move towards those sell orders, and you will make money on this stock as long as you hold and as long as data in the United States and our economy continues to get better and interest rates get cut. This is likely, especially with where AMD is going. Looking at Meta, pretty much the same thing. Meta hit a peak here in the downtrend at 661, had a lot of trouble breaking it, eventually did, and now using the same resistance as support, something I teach in Discord, support and resistance right here, support, resistance. And so it then resisted the $705 mark, which has a lot of resistance in here. And there's even more at 738. In my opinion, I feel like Meta this week on Monday going into Tuesday is going to dwindle back down, kind of fall back into the 660 range, maybe 650. And as data comes out Tuesday, Wednesday, Thursday, and gets better into Friday, Meta starts to run. If we get rate cuts and data is good, it'll challenge this high 700 range or low 700 range, 710, 720, and work its way up. And that's what I really expect from Meta. Otherwise, it could end up, working its way down if we don't get rate cuts and data isn't good. I see it settling in here in the 640, 650 range, maybe 660, somewhere in here. Looking at NVIDIA, they own pretty much all the market share when it comes to chips and AI. So their market share is only going to go down. They'll still grow, but it's going to slow down. It is going to definitely slow down. The days of NVIDIA running on earnings from 140 to 180, and then the next earnings is 200 to 260, and in 2 or 3 earnings cycles, which is 3 quarters, you quadruple the stock. Those days are done. I don't think that's happening much anymore without having some major news or catalyst that might happen once in a while in a blue moon, so to speak. But I think those days for NVIDIA are pretty much behind them because you can't keep doing that. It's not logical. And in my opinion, NVIDIA is a little bit overvalued at the current price. Not by much, but some analysts have it overvalued. They do. And when you look at NVIDIA, it's pretty much been between 140 and 150 for over a year, going all the way back to when Jim Cramer said to buy June of 24 when it was 133, and it spent the whole year going up and down, then a big dip, and then back up. It would have taken you a year to make 8% on NVIDIA. Unless you timed it out and bought all the way at the bottom, then maybe you made 20 or 30% in a year. But if you had bought Palantir, you would have made about 300%. Or SOFI would have made almost 300. If you had bought SoundHound, then you would have made about 500%. So this 10%, 8%, even 20 or 30%, if you even bought down here, which you likely didn't. But if you did, you still only made about 1/10 of what you could have made in other stocks. NVIDIA has just slowed down. Granted, with things the way they're going, if tariffs start getting better and more deals come through and rate cuts happen, NVIDIA will work its way up. I have a price target at the end of the year, potentially on NVIDIA of about 160. And I think that somewhere up here, 160 160-ish. It could go a little bit higher than that, maybe 170-ish. In the coming few years, 2 to 3 years, NVIDIA could be pushing 250 to 300, but it's more likely between 2 and 250. I just think the growth on NVIDIA, not 100%, but likely has slowed down semi-permanently to permanently just because that's how things go. Looking at Microsoft, I told everybody in my Discord and on YouTube back in November, even before that, even in September, Microsoft would be the first American 4 trillion club, and they're headed there now, 3.53 trillion. NVIDIA is 3.46. So right now, Microsoft is king, and they're sitting at all-time highs at 474. This is ultimately a great stock to buy anytime, even where the price is right now, but I would not want to just start buying right now. If I already had AMD or NVIDIA, Microsoft, any of these stocks I talked about, you could always dollar cost average my 33-10 rule, which basically is something I created from hedge funds and created over years of experience to balance your portfolio out. You get 33-10, which is 3 trades out of 100. Okay, 33-10, 3 trades into 10, 33 into 100, 33-10 rule. And I would buy 2 on the low, maybe 1 here, and then 1 on the high, giving you an average somewhere in here, which is what dollar cost averaging is, DCA. Dollar cost averaging does not mean dollar cost lowering, means you only buy down here. This is incorrect because 1,000 shares of Microsoft at 450 is still going to give you more money if the stock goes to 500 than 200 shares at 420 would be. Doesn't matter how you hack it, more shares, more money. So you average your cost over time. Call it the Warren Buffett, so to speak, but it's partially Warren Buffett's strategy. Time plus good stock, 2 things you need: good money, good profits, and success. So Microsoft, if I was to get into Microsoft like Meta, I'd want to be selling puts a month out, maybe down 450, 460, maybe a little bit lower. This way, if the stock does drop, I'm getting in down here and not way up at this peak up here. In fact, if I had an opportunity and wanted to get into Microsoft, I really would like to get in between 420 and 440. So if you can sell 440 or 445 puts going a month out consistently, then even when you do get a sign, you'll have an average cost in the 430s, which is down here, which is not too bad. It's in the median average, which is in the middle of my AVP. And my AVP on Microsoft is between 395 and 425. So the center of the AVP would be 420. So 430 is not far above that. It's right in here, which is pretty decent. And you could achieve that by going a month out on puts. So my AVP on Meta, you guys can see right here, is showing us where the average price is on Meta. And I would honestly not want to get into Meta outside of this window right now. The AVP is 481 to 570. This is really the average weighted price. So if you can get in anywhere between 560 and 609, so right in the low sixes would be great. You can go out about a month on Meta selling 640s. And if you consistently sell 640s, which is down here, a month out, you do this 2 or 3 months in a row, you'll have an average cost around 610 or 604. And that's how you lower your cost. Looking at SOFI, a very strong stock, especially staring in the face of geopolitical issues like we currently have. But the one thing that could hurt it is the lack of interest rate cuts or a delay thereof, and that would not be good. However, the tariff news and geopolitical issues have less of an impact on SOFI. They also have a great CEO who said in an interview during earnings a few quarters ago that it's not a matter of if, but a matter of when SOFI becomes the biggest bank in America. And I believe this is ultimately true. SOFI is a great stock, and I think that if you can get shares between $12.50 and $13.50, it is very good. So the current price at $14.09, I've told Discord many times, sell $13.50 and stagger it with 13 puts and continue to sell these puts week in and week out, month in and month out, because if and when you get assigns, which eventually could happen, you'll have an average price in the $12.50 range, maybe even $12, which is way near the bottom of the AVP, which is really good. And you might be asking me, Corey, how does this work? Well, if you sell a $13.50 right here, right down there, and let's say you're going a week out and you're getting $20 a week, that's $80 a month. You do this for 2 months, that's, 2 months equals $1.60. So $1.60 off $13.50 is $11. 1190. So if you do this right for 2 months, even if you get assigned at 1350, your average cost is 1190, which is way down here. So you're at the bottom of all of this. You have all this upside on SOFI. And the more you sell put options consistently and safely, the lower your average cost will be. And SOFI ultimately is a long hold, so you want to be DCAing, which I've explained many times. You want to DCA and use my 3310 rule. I teach this in Discord. If you're new to trading, new to investing, losing money, I want to show you how to turn those losses into wins with my AVP DCA 3310 rule, and showing you how to look inside the candlesticks, which I'll give you a brief preview in this video, so don't skip anywhere. I've got that coming up, and how to gauge the market Sunday night going into Monday every single week, and it's what I use. But if you want to learn these strategies and grow your portfolio, and you want me to show you how to turn your losses into wins, just like my current students, you can see on the screen, 8,000 portfolio into 40,000 in 5 months, 300K into 800K, students that had $140,000 losses, and we made it all back in about 2.5 months time. If you want to be in their position and grow, link to join Discord is in the information box below. I look forward to seeing you in the Discord real soon. So with all of this being said, you really need to understand you want to be buying here, and then maybe one up here, giving you an average right here consistently. More shares, more profit when the stock goes up. This is all about averaging your cost while accumulating or stockpiling. See what I did there? On these stocks. That's what you really want to do. Stockpile. You want to add them up, but you also want to keep it below 10% of your portfolio. Looking at Palantir next, pretty much the same thing. AVP is way down here. Palantir is a very popular stock. Everybody wants to trade this stock, but you have to be very careful because it really is at all-time highs, and it's trying to continually break the barrier on the ceiling. Inevitably, it is eventually going to fail in this department somewhere with news, tariffs, data. Maybe it's geopolitical issues that affect it slightly, or bad earnings, and it's going to pull back. All stocks do. There's going to be a little bit of a pullback, and I have a target range in between 122 and 128, maybe even down in the 115, 120 range, somewhere right around there. It would not surprise me, because if that happens, well, then the stock is going to go back to the average, which this current rate is right about there. So that is very possible. Me personally, I would like to get into Palantir somewhere between 85 and 100. I think anything over 100 is overvalued. I do think this company going forward in the future is worth 135, but it's very much so baking in all of the premium for future guidance in 2026 and the rest of 2025. It's also baking in future contracts that are potential. It's also baking in rate cuts and a better economy this year getting better. And it's also baking in to its price that we're going to work out tariffs. So the moment any or more than one of these things don't happen or work out, well, then you guessed it, then the stock's going to come back down. So what I would like to do is go out a month, and at least a month, and sell $105 or $110 put options a month out, because they're going to be worth $100, $150, maybe a little more, a little less. If you do this for 2 or 3 months in a row, then you have an average cost of 107. You do it 4 or 5 months in a row, you're closer to 100 down here. So selling put options will get you that lower cost down here if you think the stock is going to drop or continue to consolidate. Right now, the stock is at an all-time high, and it's really hard to decide whether or not selling put options or call options would be right. So we have to see where the stock goes this week. If it starts dipping, I would wait for it to dip completely, consolidate, wait for data to come out. And as soon as we see green candles forming and it starts to go back up, we're looking for an engulfing green candle. Once it happens, the stock happens to do that down here at, say, 122. We'll go all the way down to 106 or 105 and sell put options a few weeks or a month out, because then the stock would have to drop drastically even more to even put you in danger. And if you get the stock at 105 or 110, then it's not too bad. It's a lot better, and you're lowering your average cost. You're lowering your risk. That is what I would do, and this is how I handle it in my account all the time. Right now, I'm going to show you guys how to gauge the market Sunday night going into Monday morning, and exactly how to do that. Stick around. We're going to look at Tesla and SPY right after that. What you want to do is go to the MES Micro E-mini S&P 500. This is your futures. They open 6 p.m. Eastern time, 3 p.m. Pacific on Sunday nights. And when the market opens in China and Japan in the middle of our night, midnight, 11 o'clock. Then it's going to open in England and Europe shortly after that. So there's going to be a lot of trading in the overnight hours. When we look at what happens typically, we can see the market wasn't good on Friday. And right here, if we were to look into the 5 a.m. time frame, it came up, resisted, then it ran up and ran down. But we're specifically looking for the overnight hours Sunday. Let me show you how powerful this is, because if we gauge that on Sunday right here, 8 p.m., a lot of bullish momentum Sunday at 6 p.m. on May 25th. And if we go look May 25th on the SPY, you will see this is May 25th right here. See, May 25th, Monday, it gapped up Monday night, just gapped right up. And that is because of what happened right here in the overnight hours. If we look at another time it gapped up, which was May 9th, we'll see a big gap up Sunday, May 11th, May 11th, it just gapped up. And this happened at like 6, 7 o'clock at night on Sunday, May 11th. So let's go look at May 11th, and you will see that on Monday, May 12th at 4 a.m., the SPY gapped up. If we were to go look at another stock like Tesla or Nvidia and go look at May 12th, which is right here, the stock gapped up. So you can see that it's very indicative of what's likely to happen Monday morning by looking at the mini NASDAQ and the mini S&P futures. Monday is going to be tricky with data coming up this week. I expect some consolidation, but if we see a gap down, a candle like this, then obviously this gap down and consolidation shows weakness, and that Monday is going to be rough and you can prepare the night before. If we see a gap up, which is unlikely but could happen on good tariff news for sure, or geopolitical issues go away and there's some form of peace this weekend, which is hard to say if that's going to happen, but unlikely. But if it did, then that would happen, or it'll just simply consolidate down like this or up like this. So it could do either direction, but it's going to show you what the sentiment is in the overnight hours on Sunday to give you a very big indication of what's likely to come Monday morning. And this is something I teach to my students in Discord consistently because of how powerful of a strategy it is. And it truly works. My students will attest to that. It is very powerful. It gives you insight into the data Monday morning, Sunday evening, and Sunday in the overnight hours and early morning. It shows you what the sentiment and the bias are in the overnight hours Sunday into Monday. Very, very powerful strategy that I created over the years of trading that has really helped me a lot. And it's now helping my students. And I'm hoping that it's going to help you the same way. Looking at Tesla, this is a stock that concerns me mainly because of the volatility and because of the issues that Tesla has had with robotaxi, the government investigations, with the issues with the autonomous driving and the robotaxi, their robots, and the issues surrounding those. We also have the fact that the company has missed earnings 3 out of 4 times. Elon Musk saying very odd things and having odd behaviors. The company not generating enough growth. We also have EV mandate issues with the current administration and cutting those mandates, removing them, altering them. All of these issues are not good for Tesla at all. Tesla still long-term, I believe, is good, but if you can't stomach the volatility, I would not be trading it. Tesla approaching pretty high peaks of 370 right now, working their way back up. All-time highs way up here at 483. So when you overall look at Tesla, my AVP on Tesla is really between 230 and 300. Really, the average could be raised, but I don't like counting the peaks in volatility. But even if I was to do so over the last year, the AVP would be between 260 and about 300. So really, if you can get in between 280 to 320, you're okay, I would think, but I would not want to be in above the current price. Like really, I would like to be in right here. Between 275 and 290 is really where I'd want to get in on Tesla. So if you must trade this stock, it is a no-brainer to go out a month and sell like 275 or 280 puts, because if you get assigned at 275 or 280, that's not too bad. That is pretty good. And if you're able to sell those 2 or 3 months in a row, then you're going to end up having an average cost, even if you get assigned, of around 250 or 240, which is really good. So you really want to consider selling puts on Tesla no higher than 300 at the highest. I'd be 300 or less going out 2 weeks, 1 or 2 weeks. If I'm going to go out a month, I'm going to be down in the 270 range or 260 range, somewhere down here. This way we can buy the dip, get a sign in the dip, lots of premiums, but I would not want to be at bag holding Tesla and buying it at the current price. And you can't stomach the volatility, I would not trade Tesla. It's a very good opportunity to make money, but it's volatile. Anything can happen at any moment. The government could shut robotaxi potential down, or there could be even more issues. They could do even worse on the next earnings, and then Elon Musk could open his mouth and say something really stupid, and then the stock is down at 241, and you've lost thousands of dollars because of this. It's a very volatile stock, and with volatility comes good premiums, but also comes a lot of up and down. When you look at the up and down, Tesla has been able to go from 488 to 215, a 50% move down, and like a 30% move up, another 20% move down, all in a matter of 4 months. You do not see that on good stocks that are safe. Nvidia had like a $20 move up and down, $30 move. Even Palantir doesn't move like that, and it's heavily volatile. When you look at Microsoft, and we go over the course of the last few months, Microsoft has moved from 470 to right around 350. So 120, which is a 30%. So 30%, 40%. So not quite as much as Tesla. And if you notice, it's above its all-time high. This is strength. A stock that consolidates, has some drop with the market, comes up, gets better and better and better, and breaks and goes above the most recent high, and it now becomes support. This is strength. We look at Tesla. This is not strength. This all over here, in my honest opinion, all of this range right here is overvalue. I would not want to be in Tesla ever above 348. It's just not worth it. It is overvalued, so you got to be very safe when looking at Tesla. The only real way to gauge the market beyond these stocks is also looking at SPY, but you have to understand what encompasses SPY. Apple, Amazon, Google, Meta, Microsoft. These stocks have a very big control over the SPY. Of course, Nvidia as well. Apple is the big one. So if you're ever watching the SPY and you're like, why is the SPY going down, but Google and Nvidia are going up, Microsoft and Meta are doing okay? Why is it going down? Well, if Apple's taking a beating, then SPY is going to struggle. In order to counteract Apple, you're going to need at least two of the other big ones to counteract it. So if Apple's getting beat up, then you need Microsoft, Meta, Google, or Nvidia, or Amazon. One of those stocks, actually two of those stocks, have to be doing fairly well, or one has to be on an absolute tear in order to counteract if Apple's getting beat up or if Amazon's getting beat up. If any of those stocks are getting beat up, at least two of the other ones have to do well in order to make up for it. So if Apple's getting beat up and dropping, and Amazon, Meta, Google, Nvidia, Microsoft, they're all working their way down or sideways slowly, then you're going to see something like this. The stock will just have a lot of trouble. It'll just keep consolidating and dropping, and that's because Apple's holding it down, or whatever stock is going down. When you look at the SPY, it is Apple, Meta, and it is going to be Microsoft, Amazon, Google. You also have Nvidia. These are your big ones. These are the ones that have big amounts in the SPY, especially Apple and Amazon. They hold, and Microsoft, they hold big percentages. So if you got Apple and Amazon getting beat up and Microsoft is coming down or consolidating, then you really need Nvidia, Google, and Meta to all be pulling along with other stocks in order to counteract that. Apple's been taking a beating this past 3 or 4 days, right? Well, that's the reason why SPY is going down. The market is in general, but Apple's creating this. If Apple was consolidating or on a tear, then SPY would be up here somewhere. This is created overall from the market, but Apple has a big say in that. So just understand that's how the SPY works. The SPY is nearing all-time highs, would not want to own it at this current price. Ultimately, you want a dollar cost average, like I said, 33.10 rule, my AVP, and we can see that the AVP is between 577 and 585. You really want to be getting in somewhere around 580. I personally have gone out 6 weeks and sold 570 puts. I'm collecting a lot of this premium. So even if I do get assigned at 570, my average cost is going to eventually be 550 because I've been doing this for quite some time. In fact, since the beginning of May. So I've accumulated a lot of premium. So this will work out if you get assigned. If you don't, then it's free premiums, but you don't want to be just straight buying SPY, in my opinion, at the high prices. And you don't want more than 10% of your portfolio in any one ETF, one stock, or one sector. Although SPY is a little bit safer because it's an ETF and it's diversified so well, you could go higher than 10% at your own risk. Just understand the risk of that and be very safe when you're trading. For everybody who stuck around, I want to show you how to look inside the candlesticks, and this is what hedge funds do. And I teach this in my Discord, in my mastermind class, in my elite coaching, my one-on-one private coaching. You see these candlesticks on this big red drop, you might say, Corey, this resistance here or this resistance here was a selling indicator. Ultimately, when you look at this, even on the 4-hour chart, if you were to gauge it, you'd look at this situation and you'd say, you know what? I think that it'd be time to get out somewhere at this red candle. It's selling off down here and you get out. So you can make the argument that you might get out somewhere down here. Well, if we look at volume footprint, which is inside the candlesticks, cha-ching, it shows you what people are doing, what the buying and selling is happening. Order and flow is better. It's what dark pool data shows. I can't share that. It's proprietary, so I can't share it in here. But order and flow is better than volume footprint. But this is all I can show right now. Volume footprint is very powerful. When I am looking at these candlesticks, I can see 6K versus 795. There's more buying than selling. But over here, it's totally switched. And there's a lot going on. And we can see right here, the selling has overtaken the buying. From 2.5 million to 2.6 million on the buying, it's now 2.14 to 2.01. And it's kind of going back and forth. But once I see all of this selling pressure, and then we come over here, I can clearly see there's more selling than there is buying. And what happens is I would be getting out somewhere either here or here, which is way above there. So when we go back to the regular candlesticks, you can see that I would have got out at 602 instead of 600 or instead of 598, because these candlesticks actually show me what's going on. So instead of having to wait to see candlestick patterns, which I no longer have to wait on, I'm looking at raw data that shows me sellers are overpowering buyers in real time inside the candlesticks. It's what dark pool data and hedge fund data accumulates and shows, and the hedge funds use this data, and this is how they traded hedge funds, and this is what we used. This is what I look at, and it gives you insight on how to gauge the market quicker and more accurately. If you enjoyed this video and want to learn more just like this, the link to join Discord is in the information box below, and you could grow your portfolio and make the profits like you're seeing on the screen. I would love to help show you how to turn your losses into wins or how to tighten things up and grow even more. This Monday is going to be a little bit rough and choppy, but if data is good on Tuesday and we get rate cuts on Wednesday, the market's going to fly even if we don't get rate cuts, as long as data is good and the overall geopolitical tensions overseas don't get worse and maybe they ease up, things will be okay. But that is very important to look at as well. I look forward to seeing you guys in the Discord real soon and on the next video. Take care of yourselves, fam.